Hello and welcome to Profiles in Risk. This is your host, Tony Cañas, and today I have with me Jeff Radke, co-founder and CEO at Accelerant. Jeff, thank you for joining me today. How's it going?
Great, Tony. Thank you for having me. Happy to be here.
My absolute pleasure. I do have to say your reputation precedes you, at least Accelerant's reputation, because I keep running into you guys at conferences and everybody seems impressed with what you guys are doing. So I hope to get my head around it today. Last week I live in Atlanta, Georgia, which has been going through a heat wave.
Okay.
As has the most of the country. And then last week I was in Fort Lauderdale, Florida for Rice Leadership Summit and award ceremony, and it was hot as all get out. I went back to Atlanta, hot all weekend, like 95 at sunset kind of thing. I'm back in Florida today, in Boca. I'll be at Dig In Women in Insurance and then Dig In, my first Dig In. And I'm driving from the airport to my Airbnb, and like Florida is Florida-ing. I probably remember to put a picture on the edit, but basically, like on my windshield, half the sky was beautiful and the other half was black. And I'm like, there before the big rain. And then torrential rain, and now it's just humid as all get out. So I'm gonna take a wild guess that Puerto Rico, we're recording on June 25th. You guys are also under like extreme heat for the summer?
Yeah, for sure. And last week I was in Rome for our member event, our European member event. So I went from Rome, which was incredibly hot, to Puerto Rico, which is always hot. Well, this time of year it's always hot. You can't really act surprised and complain about hot, steamy weather in Puerto Rico this time of year, right?
At least, hopefully, you have good AC, like most of the U.S. Rome does not.
But both of those things are true. Yes, I do in Puerto Rico, and you're right, Rome doesn't. It was tough.
I grew up in Costa Rica. The only time that I've had heat stroke was Rome in July. Yes, right. And that was a hard-learned lesson. So Jeff, we always give the guests the chance to give the elevator pitch. What is Accelerant?
Sure. Well, I'm glad you asked, Tony. So Accelerant was formed 5 years ago with the pretty simple notion that the specialty insurance value chain, especially the specialty insurance value chain, really could be improved a lot. It could be made simpler. It could be made fairer. It could be made more efficient. And really, that's what we set out to do. It sounds rather grandiose, but we set out to re-platform our little section of the specialty insurance market. And what do we mean by that? What we mean by that is, on one side, we serve specialty underwriters, MGAs, MGUs. And on the other side of our platform, we serve risk capital sources, whether they be insurers, reinsurers, or institutional investors. And our job is to build that infrastructure to connect them so it's incredibly efficient and reduce the friction as much as possible. And if you compare and contrast that with the traditional specialty value chain, it's really quite different, quite faster, much more transparent, much more efficient.
Okay, all right. So I took copious notes. Okay, so I'm a former middle market underwriter, and basically I'm a CPCU. I do have my ARE, which is the reinsurance one, but I never worked in re. I did spend 6 months at Scottsdale Insurance, what is now Nationwide ENS, back when it was the wonderful Scottsdale. But I was there in a finance role, in a corporate finance role, and to be honest, like I was a Nationwide or not a Scottsdale, right? Nationwide owns Scottsdale.
No one talked to you, I bet. No one talked to you.
They were more than happy to give me a desk, and Nationwide spent a lot of money in keeping me there for 6 months, and they even gave me a nice goodbye party and a golf shirt on the way out with the Scottsdale logo. They gave me no work while I was there.
Yeah, right.
So I did have a lot of fun in the Scottsdale area over the winter, which is the right time of the year to be there. But I didn't actually get to see the magic that they do. So my exposure to specialty insurance has been minimal. Okay, so when it comes to specialty, what I'm hearing is basically excess and surplus. Am I correct in that?
Well, we operate in the UK, Europe, Canada, as well as the US. So only the US has this notion of
Okay.
excess and surplus. So yes, yeah, from
In
an
the
American
UK,
perspective,
we're talking basically Lloyd's market.
no, no, there just isn't that notion of admitted versus non-admitted.
Okay.
There would be sort of middle market, the bread and butter straightforward business, and then there's business that's a little different. Something's wrong with it, either the
Okay.
trade or the occupancy or how long they've been in business or their loss experience. Something sets it out from the standard market.
Okay, perfect, perfect. So my experience in interviewing hundreds of startup founders is that the more standard the lines were, the better the technology was before they came in. The more specialty the lines were, the worse the technology. So basically, I'm guessing that your area of the business before Accelerant got created was basically like chisel and stone kind of thing.
It's notoriously poor, and it's notoriously poor because for example, we today we're we're managing a portfolio of over 240 products.
Mm-hmm.
And imagine a policy administration system that's dealing with that level of complexity, right? I, if you worked at nationwide, I'm not picking on nationwide, but a big old organization trying to make that policy administration system work because the thought of upgrading it was terrifying, right? Can you imagine doing 240 products on that thing?
If I had to guess, both Guidewire and Duck Creek would have heart attacks if we ask, hey, can we put 240 different products on your platform?
Yeah, and therein lies the problem. So we can say hammer and chisel, and I knew what you meant. But what I hear too often, I think, from people that are perhaps on the outside of the industry and looking in, or perhaps don't have the same scar tissue that I or other experienced people might have, is we're not doing this on purpose. We're not doing terrible technology on purpose. There's a reason behind all this, right? There's a reason why, especially in the specialty classes, it's so difficult to do. But that aside, you're exactly right. So the specialty lines are typified by really very low help from the technology, and we set out to make Accelerant different. And we were brand new, right? So you have that luxury of
No legacy.
building it from the ground up without trying to operate what's already there. And we were very, very fortunate to put together a team of people that were both incredibly experienced on the insurance side. That's about half of them, and the other half of them never worked in insurance before in their lives, and their whole background was SaaS and analytic software and delivering things in terms of software as a service. So as a result, we've got a platform which feels like a real product driven offering, right?
Mm-hmm.
But inside it is all that insurance know-how that only comes with experience. So
Okay.
I don't feel sheepish bragging about it because I had very
Oh,
little to
good.
do
That's
with
what I'm
it.
about to
It's what the team put together is really remarkable, and more importantly than me saying it's remarkable, it's making a difference, right? It's making a difference to the MGAs that we serve. We call them members. It's making a difference to our risk capital partners. The loss ratio outcomes are better. We jump on problems better. We spend less time wondering about what the portfolio really contains. We spend more time analyzing the data as opposed to trying to find the data. What a difference. And Tony, no matter how long you worked in the industry, you know that 2/3 of your time at least was spent trying to find the data, then trying to sort it
Even in
in a
admitted, Even in admitted, yes,
Yeah.
2/3 of the time trying to find the right data to be able to underwrite the damn thing. And I was an underwriter. I can only imagine the amount of time that my UA, who was amazing and is now retired, and the processors in the background, maybe in the Philippines, maybe here, uh, the amount of time that they spent putting all of this data into the system, right? I spent a lot of time asking the brokers for the data, and then an incredible amount of time is wasted putting it into a system,
Yeah.
just so that we can have like a 20% hit ratio on the stuff we actually quote. All right, so I love the idea of replatforming this area
Mhm.
of the business. So it's been 5 years. So what does the platform look like, feel like today? So let's say if if you guys go to target markets or to WCIA, with I wish they called it WCIA, or to whatever meeting of this side of the industry, uh, and you run into an MGA at MGU that is not yet right, your salespeople like what do they tell an MGU that's not yet on the platform?
Well, first thing I'd say is the vast majority of the new MGAs that join as Accelerant members, they're inbound inquiries. So they're finding us. So
Beautiful.
why are they driven to find us? Well, they're driven to find us because of the platform, but also the approach is quite different, right? We're not handling things on a program by program basis. When you become a member, you get a long-term capacity commitment, 5 years, as long as the loss performance is appropriate and favorable.
Mhm.
You have a long-term capacity commitment, and what we say is you no longer have to spend a minute worrying about capacity. Get out there and do
That's
what you can.
amazing.
Yeah, boy, is it what a difference. You know what's the most fun, Tony, is it's fun to back a relatively young founder, a 20 or 30, man, not many 20-year-olds, but 30-year-olds or
Just a
young
couple.
40s. But you know what's fun? You know what's fun to back is back someone who's older, who uh, sort of that all that drudgery of running around London or running around Bermuda with your hat in your hand trying to secure capacity for next year. If that's all goes away, the amount of energy they have, Tony, it's like they're 25 again, right? On average, our MGAs grow 43% a year so far. And it's because of that. It's because they're so excited, and all that waste of time worrying about capacity, worrying about regulatory stuff, worrying about reinsurance. They don't have to worry about any of that. All they have to do is do what they're good at, which is pick really good risks in their niche.
Wow. Okay, that is a fantastic pitch right there. Um, I uh, what I'm most surprised about as a former underwriter, so I'm not surprised that the platform has made doing business easier.
Yep.
The 5 year commitment for capacity, that's amazing. But what I'm most surprised about is that it's improved loss ratio. Why has it improved? Why has it improved loss ratio?
Uh, so Tony, in every portfolio I ever managed, and in the portfolio you underwrote, uh, we all know this. Inside it was particularly good things and particularly bad things, and it wasn't luck. It wasn't luck. They were persistently particularly good or persistently particularly bad. And what happens is when you don't have the data, or practically you can't access the data, because it's the same thing, by the way, right? What tends to happen is if the portfolio is running at a 55, it's okay, and it doesn't get any attention because some other portfolios running at 80, right? What
Mhm.
happens when you have it on a platform, and AI helps us do this more efficiently, but this isn't an AI story. This is a data and technology story.
I was about to say, take a shot.
Yeah, right. Yeah. I deserve it.
Whenever somebody mentions AI, take a shot.
I deserve it. I deserve it. So it's not particularly an AI story. It's a technology and data story. But imagine if you could segment that book of business so that you knew that producer 3 years out of 5 is way worse than the other producers? Or what happens if you found out, here's a real story. What happens if you found out that the pubs you insured north of the river, I won't say the name of the city in London because everyone will know what I'm talking about. But what if you found out that the pubs you insured north of the river, the loss ratio was astronomical compared to the pubs south of the river? And it was systematic or systemic, right? And it was consistent. That's how you get better loss ratios, because you start doubling down on the good stuff and throttling back on the bad stuff. And when I say the bad stuff, I don't mean catastrophically bad. What I mean is you see these patterns emerge when the data is there and organized and put in front of you. And that's when you ask about what does a platform feel like. That's what increasing the platform is feeling like.
Right. That's awesome. That's a really awesome way to explain. Okay, so what I wrote down in my notes, basically, data properly utilized, properly found, etc., which is a giant problem in our industry, even on the admitted side, leads to better underwriting decisions, which leads to better loss ratio, which is a win for all of us, for all the players in the market, basically.
Certainly it is. So our member MGAs have stable capacity, and they don't have to worry about right. They can just focus on their business. Our risk capital partners to date have made some $440 million from the participation in the Accelerant Risk Exchange. So they get transparency, they get profits, and most importantly, they get that diversifying book of business, that low volatility, small to medium sized insured specialty book that's so hard to produce. And what they do is they get it delivered on a common infrastructure, right? So we get paid a fee by risk capital to source, manage, and monitor that portfolio. Tony, if you told me I had to have a stairway pitch and I only had two stories, maybe even one story, that's what I'd say. The way I'd shorten this all up is I'd say Accelerant gets paid a fee by our risk capital partners to source, manage, and monitor a portfolio specialty insurance business.
That's a really interesting way to think about it. Also, I always look at the website as I'm chatting with the people. In this case, looking at my phone because my Mac is out of RAM. I literally can't open the website. 89 average NPS score. Let's start with the fact that is ridiculously good NPS score for anything, let alone something in our industry. Rated A minus, AM best excellent, so fantastic. 155 members, 300 plus capital providers. I love the fact that there's that many capital providers, because capacity has been tricky in the last few years, and having that well diversified is really good. And I do see that you have underwriting companies in different places, right? So there's a Europe one, there's a Canada one, there's a UK one, and I'm guessing ASIC and ANIC.
Yeah. Specialties, the E&S company in the US, and Accelerant National is the admitted company in the US. And then the real story, Tony, is 6. I'm going to say approximately 6 because I suddenly lost confidence. Approximately 6 insurance companies that we don't own that are participating on the risk exchange, where they're saying, please issue policies on our behalf. So we've got investor sidecars for reinsurance capital support. We've got investor sidecars for primary business support. We've been very fortunate in the level of support that we've received from risk capital partners to date, and I hope and believe we've produced, right. We've executed in a way that sort of justified the trust that they put in us.
On the website, okay, so you've got a section for reinsurers, insurance, and institutional investors. Okay, and you explain basically what you just explained to me. 65 risk bearers, 400 billion in billion in aggregated capital.
Yep.
51% loss ratio thus far. 1.8 billion in premium, 20 countries and counting, 250 products. Okay. Then there is the underwriter and MGA section. And the one that I found really interesting is, what are synthetic captives? I hadn't heard that before.
Um, so if it's okay, I'm going to take a step back and take a running start at this.
Absolutely.
For the sake of the listeners, I'm sure you know this, Tony, but for the sake of the listeners, captives are a big business in the U.S. and curiously, they're a tiny business outside of the U.S. So something like 170 billion in the U.S. and almost nothing outside of the U.S. Really makes no sense, because this notion of captives, really, when you boil it down into its simplest form, it's people who want to participate in the performance of their underwriting. What could be better, as a former underwriter, Tony? What could be better than an insured that wants to participate in the performance of their business?
And in some ways, they want to have flexibility in setting the guidelines and how the claims are handled. And yeah, I agree. As a former underwriter, I would love an insured that wants to participate, because that is an insured that's aligned with
Yes.
my incentives.
And Tony, it turns out your instincts are right. Captive loss ratios are materially less than open market loss ratios. What a shock. Yeah, as I say, it turns out your instincts are right. So the captive space reminded us a lot of the specialty space when we went in and looked. There was a ton of steps. It took forever, like a year is fast, to get one of these set up. I don't know how it could be less convenient. If you wanted a group captive, you all had to show up on the same day. Maybe worst of all, there was no delegated authority in the captive space. So no. Each and every one is going to be underwritten by whichever the insurance company is that's issuing the paper. Then you need spec reinsurers and specific reinsurers. Then you need aggregate reinsurers. The whole thing is just a mess, right? And if you looked at it like a value chain and you showed someone in a rational industry, they'd laugh at you. They'd say, "No, you're making it up. That's not true." And of course we know it is true. So what we said is, part of the way that the risk exchange, that platform business, has reinvented or replatformed specialty insurance so dramatically is because we own each of the regulatory pieces you need to stay on side with the regulators and achieve an outcome. But what suddenly occurred to us is the same way that we're able to onboard an MGA in 8 weeks instead of 12 months, we can do a captive in 8 weeks instead of 12 months. In fact, we can go one better. We can do it synthetically with a series of contracts. So there isn't an insurance company that you have to set up in Vermont or Cayman or Bermuda or Puerto Rico or wherever it is, right? In essence, we can do it synthetically and skip that whole step, because why does anyone set up that company? No one says to themselves, geez, I would really like to own part of a segregated cell of an insurance company in Cayman. That's what I want. That's not what you want. What you want is to efficiently participate in your underwriting. So let's deliver them that. And again, this whole notion of insurance infrastructure is so awful. Like the regulatory spaghetti it's so awful. Let's only do it once, right? Let's only do it once. I think someone told me there are 4,600 insurance. I don't know if it's true, but let's say it is 4,600 insurance companies in the United States. How crazy is it that every single one does the same thing? Okay, so we're going to file rates and forms for the admitted. We're going to do all those schedule all the way to Schedule A to Schedule Y. We're going to file those every month or every quarter. It's just crazy that we don't share the infrastructure. So what's synthetic captives? It's a way to share that infrastructure and create outcomes, not headaches. I like that. I'll write that one down. That's good.
Create outcomes, not headaches. All right.
Yeah.
Yeah. You are fantastic. Either marketing trained you really well for media, or
Right.
you're fantastic at coming up with really great lines that are just.
So if you're kind enough to send the transcript back, I'll share it with the marketing people. And I have to tell you, the marketing people are terrified at the when I do these podcasts. And what I will go on to say, Tony, that it's a perfectly reasonable emotion for them to have.
No, that's fantastic. Fantastic. This has been super interesting. Um, oh, okay. So normally I ask about implementation. In this case, I don't think there's any real implementation. So if we're an MGA, we sign up with you guys. How
Yeah.
how does our system talk to your platform?
We here's how this goes. We ask you a question and we say, are you in a hurry? And if you're in a hurry, are you committed to being done quickly, or would you like this to go at a more comfortable pace? And I think we've gotten better at asking the question, because one of them is full on. We fly to you, we sit there, we get it all done, and we get it all done in a matter of weeks. That integration between the systems, what we do is we have a layer of middleware that translates in between, because there are so many different agency management systems and policy management systems, that what we have to do is we have to remain completely flexible. What we don't do, Tony, is say, here's how we're going to take the data. What a great way to get rid of lots of great data, right? Is to say, it has to fit in this sort of framework, this data model. So what we say is, we'll take everything you have. And one of the rules about being a member is you have to share everything that's in your system. Everything.
And why is that a rule? That's interesting.
Uh, it ends the discussion very quickly, right? About is this something you want to share? Because if the rule was you share what you want, or the rule was you share what you think we need, the industry has trained you as an MGA, Tony. I'm going to pick on you. You as an MGA, the more you share, the more headaches you have.
Right.
Right? Right. So you, as a rational person, are going to try and share as little as possible. And what our new members have to do is take a little bit of a leap of faith, a little bit of talking to other members, a little bit of pointing to that net promoter score, and we say, look, this is worth it to you. This is not more headaches, right? Again, this is a good outcome. This is a good outcome for you. And the way we sort of separate the wheat from the chaff is we just make it a rule, right? Because it is jarring to say you have to share everything.
So this 90s kid who is a Disney nerd, and my favorite Disney movie is Aladdin. What I have in my mind is you guys flirt with the MJ. They call you, you guys flirt, and then basically there's an Aladdin and Jasmine moment where he's on the magic carpet. She's afraid of getting on, and he goes, "Do you trust me?" Right, and that could have been the end of it if she didn't.
I
So
suppose that's right, because if they didn't, they wouldn't get on
right, but
the magic
it's a
carpet.
good way. Yeah, I agree that it's a good way to like finish your underwriting on whether you want to work with them. If they're going to be a pain on data, uh, that doesn't fit your model, and yeah, you should walk away. So that's
Yeah. And more importantly, they should walk away. So our first value, we've got 10, which I know are too many, but we love each one so much that we can't give up any of the 10. But our first one is we're member centric, right? So our job is to increase the value. Our purpose is to increase the value of the businesses that our members run. So how do you increase the value? You increase the value by producing repeatable, consistent, high quality growth. So it's a great job to have, because all of a sudden, for the first time in 35 years, I'm not trying to squeak out 20 basis points on the loss ratio, or worse yet, right? Trying to get 2 points off the expense ratio. And then someone always says we have too many subscriptions and we should cut the subscription costs, right? All that drudgery. We don't have any of that, right? Our job is to make our member MGAs more valuable. And that service mentality, that servant mentality, is so freeing. It's such an important part of our culture. I love it. I absolutely love it. It makes work relatively easy to face every morning.
Fantastic. Um, Pricing. I normally ask about pricing. You mentioned that it's a fee paid by the capital owners,
Yep. Mm-hmm.
And capacity owners. For the MGAs, is there a fee for them?
No, we're paying well, they'll of course never admit it, but I think if we were gonna sort of go give each other truth theorem, I think we pay our member MGAs market commissions.
Perfect.
Maybe a smidge better, maybe a smidge worse, but market. And what that means is they're the subsidy side of the platform, so they get all this stuff for quote unquote free because they get market commissions. So they are the subsidy side of the platform, where we're spending money, time, energy, effort on trying to make their businesses more valuable, as I said, and then the risk capital pays that fee, and that's sort of how we're compensated.
Okay. So to prevent your salespeople from getting overloaded with the wrong kind of MGAs,
Mhm.
which kind of MGAs are the ones that you're really excited to chat with? What do they have in common?
Uh, you're an underwriter first and foremost, right? The woman that runs it or the man that runs it is an underwriter, and it is so much of their self-image is tied up in them being successful underwriters
Okay.
that's really what they care about. The next thing that they do is they care about the quantitative side, uh, not to the not to the point where you ignore qualitative, the people issues and distribution, but they're quantitative people. Generally speaking, are the ones that we get along best with. No big surprise, right? With the data. Um, you've been successful in the past, or better yet, you haven't been successful, but you figured out what you did wrong. Um, we love those. We love those too. You write specialty business, commercial business. It doesn't have a lot of catastrophe exposure. It's relatively low limits, 10 million or under, generally speaking. Most of the insureds that you're covering are relatively small businesses. So what have we said? Relatively low limits, non-systemic risk, relatively low volatility. And what we're going to do is we're going to put your business into our portfolio, and you're going to get the benefit, the network effects of 1.7 billion of other business. Because one of my jobs when we have kind of a big loss, just happened today actually, when we have kind of a big loss, a 5 or an 8, doesn't happen all the time, $5 or an $8 million loss, is my job is, well, it's not just my job. Accelerant's job is to call that underwriter, right, and talk to that underwriter and say, it's a tough loss, but hey, you looked at the risk, you do it again, right? Or maybe not, and you learn something. But generally speaking, they say, yeah, I do it again. It was the right call. And we say, yeah, it was the right call. And that's why we're backing you, because you can make those determinations. And then we say, ma'am, what number are you dividing this by in your head? And she'll say, well, it was a $5 million loss and I have a $12 million book. And I said, no. Your 5 million has got to be divided by 1.8 billion, right? It's the real magic of Accelerant, right?
Oh my
You,
God, I
you
love that.
I don't know what that number is, by the way. And as I say to the underwriter, nor does anyone else, because no one's ever going to even bother to calculate what 5 divided by 1.8 billion is. So
That
relax, get up, brush yourself off.
that yes, that like I've never run an MGA, but that absolutely wins my heart. I'm a fan. Uh, I you reminded me of the worst loss I underwrote at Liberty. I was only an underwriter for 3 years. 1 year at Nationwide Ag, 2 at Liberty, Liberty Middle Market, and my territory was Mississippi. And
Tough
I lived in
territory.
Atlanta, Georgia, terrible territory. There's very little middle market business. Most of the things we saw were business we've already seen in the past,
Right.
because there's just not that much middle market
Yep.
in the state of the union, or the poorest state in the union. Anyway, I worked closely with my boss who had 30 plus years at Liberty, and we wrote the first I can't remember the exact chemical. I want to say magnesium, but I might be wrong. The first magnesium plant built in the US in the last 30 years. We underwrote the crap out of it, and we wrote it. Like single-handedly. I'm basically hitting my new business goal for the year. And within 2 months, there was a major workers' comp loss. There was an accident happened. A worker got 80% burns, survived. This loss is, I'm sure Liberty is going to pay millions of dollars on this loss over its life. Okay.
Tragedy. A
So
tragedy
a
for the
tragic,
poor.
a true
Yeah.
tragic shock loss. And then they scheduled the large loss conference or whatever, right? And I'd only been at Liberty for like a year and some. I'd never been through one of them. And I remember sitting in my boss's office doing this conference call. This was before COVID, so before Zoom, with like his boss and his boss and her boss, right? With like 16 levels of Liberty leadership, reviewing everything in the file. The call ends. I thought I was going to get fired, basically. I thought my career as an underwriter was over. The call ends, and my boss is like, okay, go back to your desk. And like, I literally had to ask him, I'm like, Dan, is that it? And he's like, yeah, that's it. And I'm like, I thought I was coming in here to get fired. And he said, Tony, we're in the business of paying losses. We underwrote the crap out of this thing. We did everything by the book. You worked closely with me. We got the right authority from the right people because it was so big that even his authority wasn't. We got loss control involved. We did everything. We're in the business of paying losses, right? So I tell that story to people who call me for career advice who are going into underwriting, who are afraid of making $1 million decisions for the company.
Yeah.
Right. And I love to hear that in the MGA world, at least at Accelerant, that is also the case. So thank you so much for that. Okay. Anything coming down the pipe? By the way, this episode will likely go out on July 22nd or thereabouts, probably July 22nd. Happens to be my mom's birthday, so happy birthday, Mom.
It's my daughter's birthday.
Oh, wow.
Day after my daughter's birthday.
Oh wow, okay. Anything coming down in the future of Accelerant, the rest of 2024 or 2025 that you can already talk about, that you're excited?
I think look, last quarter we created 38 new products with our member MGAs. There's tons of stuff happening all the time just because of the energy and the skill of these member MGAs. So what are we going to do? We're going to continue to execute on their behalf as well as we possibly can. I think the synthetic captive thing is going to have legs. We've got three done now. I think it's going to get very big very fast. I wonder if it's not going to get reasonably big in the UK and in Europe and sort of surprise everyone. We're really, really excited about that. And then we're always working on new and innovative ways to bring risk capital to our members. So, Tony, I don't know if we'll make it by this episode. In fact, I don't think we will. But we're working on some big stuff, which, if we're successful, will be certainly before the end of the year, another way to bring risk capital to our members so that they can pursue all their opportunities.
when you're ready, we'd love to bring you back for an update when
Oh,
you're
great.
talk
You
about it.
don't have to ask me twice.
Perfect. Absolutely fantastic. Jeff, this has been just an absolutely fantastic conversation. One of my favorite podcasts. Out of 560, you're at least top 10%, maybe top 5%. Definitely for the Hall of Fame. I'm a
Right.
magician, by the way. Uh, uh, Jeff, one last very, very important question.
Okay.
Are you still a Packers fan?
Yeah, of course. Of course. And
Fantastic.
Sarah Vierkamp, the Vikings still are just terrible. So
as I was looking at your LinkedIn, I noticed about 15 minutes ago that you went to school in Wisconsin. So I don't know if you're from Wisconsin.
yep,
But
both. Yeah.
okay. I tell my girlfriend that I am Iowan at heart. I'm from Costa Rica. I went to school in Iowa, spent 10 years in Iowa.
Right.
And one of the things I picked up in Iowa is a love for the Packers.
All right. Good.
So yeah, I've been to, what's the name of the stadium?
Lambeau Field.
Lambeau. I've been to Lambeau. Watched the game at 5 degrees, which I've been told is the right way to do Lambeau. Amazing experience. So yeah, thank you. Thanks so much for your time.
Right. Not at all. Thank you, Tony. Nice to meet you. Take care.
So thank you so much for your time today. Super interesting. I learned a lot, and no wonder that I keep running into people that mention you guys. Now
You're very kind. You're kind.
now I get it. Yeah, thanks so much for your time today. Looking forward to
Absolutely.
you and your team out on the road.
We'll talk soon.
Thank you so much
All right. Take care.